Greetings, everyone, and welcome back to Updates with John. Today, we're dissecting a confluence of financial events that have sent ripples through the markets. Silver is experiencing a significant downturn. Gold has breached a critical threshold that many on Wall Street deemed unbreakable. And the most substantial initial public offering in recent memory has shed hundreds of billions in value within a mere 72 hours. These three distinct yet interconnected market movements all point to a single pivotal report scheduled for release tomorrow morning at 8:30 a.m. This upcoming data could either ignite a robust recovery across precious metals or precipitate their most severe collapse in a decade. My name is John, and you're tuned into Updates with John, the platform dedicated to demystifying complex financial landscapes into clear, honest, and genuinely insightful educational content. Today, I require your undivided attention for the next 25 minutes, as the insights I'm about to share are either being entirely overlooked by most financial commentators or are deliberately being presented without their crucial interconnections. Consider the recent headlines. Silver has plunged to its lowest point in 6 months. Gold has fallen below the $4,000 mark for the first time since November 2025, and a major aerospace company has seen its market valuation diminish by an astonishing $600 billion. Concurrently, the market's expectation for a Federal Reserve interest rate hike has surged from a mere 29% just a week ago to a commanding 68% as of this morning. These are not isolated incidents. They are threads woven into a single overarching narrative. By the conclusion of this discussion, you will possess a more profound understanding of this story than 99% of investors currently observing these markets. We commence our analysis with silver, as it is undoubtedly the primary focus today and the metal that warrants your immediate and comprehensive attention. Let's begin. Before we delve into the intricate analysis, allow me to provide you with a comprehensive overview of today's silver market data, ensuring you are fully apprised of its exact standing as of Wednesday, June 24th, 2026. The spot price of silver is currently hovering around $62.34 per ounce, reflecting a notable decline of 4.23% within a single trading day. To truly grasp the magnitude of this figure, it is essential to contextualize it against its recent history. Cast your mind back to January 29th of this year, when silver achieved its all-time high of $121.67 per ounce. From that historic peak to its current price of $62.34, silver has relinquished approximately 48% of its value in less than 5 months. Nearly half of its entire valuation has evaporated. The 52-week trading range for silver spans from a low of $35.40 to its zenith of $121.67, which vividly illustrates the extraordinary rally that preceded this current correction. Despite this brutal downturn, silver remains an impressive 69.25% higher than its value precisely 1 year ago, underscoring the formidable strength of its longer-term trend. The gold-to-silver ratio, a crucial metric for precious metals investors, currently stands at 66.1, marking a 2-week high. This figure holds immense significance because the historical average of this ratio over the past century is approximately 40-1. When this ratio exceeds 60, precious metals analysts have historically identified silver as being substantially undervalued relative to gold. At 66 to 1 today, silver is considerably stretched beyond that historical average, a factor that long-term investors consider with utmost seriousness. Today's intraday trading range for silver has fluctuated between $58.01 on the lower end and $62.37 on the higher end, indicative of significant intraday volatility and reflecting the palpable uncertainty pervading the market at this moment. Now the pertinent question arises: why is silver experiencing such a dramatic decline specifically today? There are several interconnected reasons, and I intend to elucidate each one with clarity, as understanding the underlying causes is the sole pathway to anticipating what might unfold next. The foremost and most impactful reason for silver's current predicament is the dramatic shift in Federal Reserve interest rate hike expectations this week. Merely 7 days ago, the market-assigned probability of the Federal Reserve implementing an interest rate hike in December 2026 stood at approximately 29%. As of this morning, that probability has surged dramatically, now ranging between 68% and 89%, depending on which futures market data you consult. This represents an extraordinary repricing of monetary policy expectations within the span of just 1 week. Markets have fundamentally reevaluated the entire outlook for interest rates in a mere 7 days, given that silver is a non-yielding asset, meaning it generates no interest or dividends. Rising interest rate expectations directly diminish its attractiveness when compared to bonds and other savings instruments that are now offering increasingly competitive returns. This constitutes the most fundamental pressure point on silver at present, and it serves as the connective tissue for all subsequent points of discussion today. The second contributing factor to silver's decline is the recently signed U.S.-Iran peace agreement in Switzerland. While one might intuitively assume that peace universally benefits all assets, including precious metals, the relationship is, in fact, more nuanced. The U.S.-Iran peace accord has facilitated the unimpeded flow of traffic through the Strait of Hormuz, a waterway of paramount importance for global oil shipping. This development has led to an approximate 2% fall in oil prices today, and lower oil prices in turn tend to reduce inflation expectations. When inflation expectations recede, the rationale for holding silver as a hedge against inflation consequently weakens. Furthermore, a reduction in geopolitical tensions generally diminishes the demand for precious metals as safe haven assets. Thus, paradoxically, a peace deal that is unequivocally beneficial for global stability is, in the short term, exerting selling pressure on both silver and gold by alleviating some of the fear premium that had previously underpinned their prices. The third reason for the current market sentiment is a technical breakdown triggered by a broader sell-off within the technology sector. When prominent technology stocks experience sharp declines, institutional investors who typically manage diversified portfolios encompassing both technology equities and precious metals. Exchange-traded funds, ETFs, frequently liquidate their metal holdings to offset losses or to rebalance their portfolios according to predefined risk parameters. Today, the technology-heavy NASDAQ Composite Index registered a 1.4% decline in morning trading, wiping out an estimated $680 billion in market value. This selling pressure directly cascaded into silver and gold as fund managers adjusted their exposures. The fourth factor is the persistent strength of the U.S. dollar, which renders silver more expensive for buyers utilizing other currencies, thereby dampening global demand. Historically, there has been an inverse correlation between dollar strength and silver strength. Currently, the dollar is benefiting significantly from the escalating rate hike expectations we previously discussed. Now let us transition our focus to the gold market, as it has breached a level today that warrants serious deliberation. As of this morning, the spot price of gold has receded to a range between $3,975 and $3,988 per ounce, marking a decline of 3.07% within a single trading day. Gold has now fallen below the psychologically and technically significant $4,000 per ounce threshold for the first time since November 2025. This constitutes a pivotal event. When a major asset breaks below a round number that has historically served as a support level, it frequently triggers additional selling pressure, as automated trading systems and risk management algorithms are often programmed to reduce exposure when such key support levels are compromised. At 9 a.m. Eastern Time today, gold was valued at $3,988 per ounce, representing a $125 decline from the same time yesterday. Nevertheless, it remains $671 higher than its value 1 year ago, indicating that even after this correction, the one-year trend retains a positive trajectory. Gold is currently down approximately 5% year to date in 2026 and is trading nearly 20% below its all-time high of $5,595, which was achieved on January 29, 2026. This implies that gold has shed roughly $1,500 from its peak valuation. Markets presently assign an approximate 68% probability of a Federal Reserve rate hike in September, a dramatic increase from just 29% a week prior. This rapid repricing of rate expectations is the primary catalyst for gold's current weakness, and it directly correlates with tomorrow's impending data releases, which we will examine in detail shortly. The fundamental reason why higher interest rates adversely affect gold is straightforward. When real interest rates, that is, the interest rate on government bonds adjusted for inflation, rise, investors can secure a positive real return from holding bonds without incurring any price risk. In such an environment, gold, which yields no interest, becomes comparatively less attractive. Since gold attained its all-time high in January, real yields have climbed significantly, and gold has responded by declining nearly 20%. This exemplifies textbook monetary policy transmission functioning precisely as economic theory predicts. However, before we paint an entirely pessimistic picture for gold, it is imperative to understand the actions of institutional investors and central banks with their capital right now, as there is a striking dichotomy between the behavior of retail investors and the world's largest and most sophisticated market participants. Central banks, for instance, acquired a net 244 tons of gold in the first quarter of 2026 alone. Crucially, they did not cease this buying activity when gold retreated from its January peak. They continued their accumulation throughout the correction. Goldman Sachs maintains a price target of $5,400 for gold by year-end 2026. J.P. Morgan Global Research projects a target of $6,000 by the fourth quarter of 2026, further escalating to $6,300 by the end of 2027. Morgan Stanley forecasts $5,200 and UBS anticipates $5,500. Every major institutional forecast positions gold at least 25% above its current trading level. The question that every investor must confront is a simple one. Why are the world's most sophisticated investors and central banks aggressively accumulating gold while retail investors are divesting? The answer to this question necessitates an understanding of what these institutions perceive in the long-term data that the short-term market noise is currently obscuring. Now let us turn our attention to a truly captivating aspect of today's financial narrative, the story of SpaceX. This is the segment of our analysis that I believe most other channels are entirely missing. SpaceX shares are currently trading at $150, 5.35 today, reflecting a 3.01% decline. However, the truly astonishing figure emerges when we examine its performance over the past 3 days. SpaceX reached its all-time high of $225.64 on June 16th, a mere 8 days ago. By June 23rd, shares had plummeted to $147.11, marking its all-time low since its initial public offering, IPO. Over this brief 3-day period, SpaceX shed an astounding 23% of its value, erasing over $600 billion in market capitalization. To put this figure into perspective, $600 billion surpasses the entire gross domestic product of many nations globally. It exceeds the total market value of almost every other company on Earth, and it vanished within 72 hours. The immediate catalyst for this accelerated sell-off was SpaceX's announcement that it would be issuing investment-grade bonds for the first time in its corporate history. This move is part of what is anticipated to be a colossal borrowing program aimed at financing its ambitious artificial intelligence endeavors. When a high-growth company, which investors have typically acquired for its explosive equity upside, declares its intention to undertake significant debt, it fundamentally alters the risk profile of the investment. Equity investors who purchased SpaceX at $220, driven by their conviction in its boundless upside potential, react differently when the company begins to issue bonds, as debt introduces obligations and constraints on future growth expenditures. This announcement, coupled with the broader weakness observed in the technology sector and the prevailing rising interest rate environment, created a perfect storm for SpaceX shares. The stock briefly dipped below $150 on June 23rd, which was its initial trading price upon its debut, meaning that at one point the entirety of its post-IPO gains was completely erased before a slight recovery. Now here is where the SpaceX narrative directly intersects with the stories of silver and gold across two distinct time frames. In the short term, SpaceX's decline is contributing to the weakness in precious metals through what financial analysts term liquidity cascade effects. When a stock as large and widely held as SpaceX experiences a 23% decline in just 3 days, institutional investors who hold diversified portfolios, including both SpaceX and precious metals, often face what are known as margin calls or risk management triggers. Their overall portfolio value has diminished, and their internal risk models signal that they are now overweight in certain positions, necessitating the sale of other assets to rebalance. Silver and gold, being highly liquid assets, can be quickly converted to cash, making them frequent targets when institutional investors need to raise capital rapidly. This phenomenon explains why we sometimes observe gold and silver declining on the same days that other financial assets are under stress, even though gold is traditionally considered a safe haven. In the short term, the intricate mechanics of institutional portfolio management can temporarily override gold's inherent safe haven characteristics. Furthermore, SpaceX's anticipated inclusion in the NASDAQ 100 index is generating forced selling dynamics across the broader market. SpaceX is expected to be fast-tracked into the NASDAQ 100 index within approximately 15 trading days of its IPO. Upon this inclusion, every passive index fund and exchange-traded fund that tracks the NASDAQ 100 will be mandated to purchase SpaceX shares irrespective of price or valuation. These funds collectively manage trillions of dollars and are required to precisely match the index's composition. To acquire the necessary amount of SpaceX shares, fund managers must divest existing holdings to generate the requisite cash. This creates what analysts refer to as forced selling pressure, which is not driven by any fundamental assessment of the companies being sold, but rather by purely mechanical rebalancing requirements. Gold's correlation with the NASDAQ 100 has notably increased from 24% over the past 12 months to 72% over just the most recent month, rendering it temporarily vulnerable to these equity-driven liquidity events. However, and this is the aspect of the SpaceX narrative that I find most compelling from a long-term educational perspective, SpaceX has the potential to become one of the most powerful drivers of silver demand in the entire history of the metal. Allow me to elaborate. SpaceX is actively pursuing the development of orbital artificial intelligence compute satellites, which will be powered by vast space-based solar arrays. The company has already described early satellite prototypes capable of generating 100 kilowatts of compute power, with ambitious plans to scale this capability across an extensive constellation of satellites positioned in dawn-dusk sun-synchronous orbits, where they would receive near-constant solar exposure. Furthermore, SpaceX acquired xAI, a prominent artificial intelligence company, in an all-stock transaction in February 2026, with the explicit goal of constructing space-based artificial intelligence data centers. This strategic move aims to circumvent the inherent power and cooling limitations encountered by ground-based facilities. These orbital data centers, alongside the continuous expansion of the Starlink satellite constellation, will necessitate immense solar power generation capabilities, and crucially, every single solar panel requires silver. Silver possesses the highest electrical conductivity of any metal on Earth. Solar panels utilize silver paste within their photovoltaic cells to efficiently capture and transfer the electrical current generated by sunlight. Critically, there is currently no commercially viable substitute for silver in this essential application. As solar capacity continues its global expansion, and particularly if space-based solar power emerges as a significant technology for powering orbital computing infrastructure, the demand for silver will escalate in ways that current supply chains are simply not equipped to meet. The global silver market is already grappling with its sixth consecutive annual supply deficit, estimated at 46.3 million ounces. This deficit is widening because mine supply is declining at a faster rate than industrial demand is increasing. Some analysts project a potential annual deficit in silver that could, if current trends persist, exhaust all existing above-ground inventories within approximately 3 years. This represents an extraordinary supply-demand imbalance that is largely disconnected from the short-term price movements influenced by Federal Reserve policy and the immediate dynamics of the SpaceX IPO. Intriguingly, large institutional investors appear to be quietly positioning themselves for this long-term silver thesis, even as short-term prices experience volatility. Citadel, one of the world's largest and most successful hedge funds, initiated a significant new position in SLV, the iShares Silver Trust Exchange Traded Fund, in the first quarter of 2026, precisely when silver prices were in decline. When a fund of Citadel's sophistication takes a new position in a falling asset, it strongly suggests they perceive underlying value that short-term price fluctuations are obscuring. The gold-to-silver ratio, currently at 66:1, sits well above its 100-year historical average of 40:1. Historically speaking, when this ratio has been similarly extended, silver has typically outperformed gold significantly in the subsequent 12 to 24-month period as the ratio reverts towards its historical mean. This suggests a powerful long-term bullish case for silver, despite the current short-term headwinds. We will continue to monitor these complex interplays and bring you the most relevant updates. Stay informed, stay vigilant, and remember that understanding the deeper currents is key to navigating these markets. Until next time, this is John signing off for Updates with John.